Akhil, a lot of us have confirmation bias, right? Because we have been investors in this market. So we choose to believe that the economy is doing okay, the market will always pick up. But if you look at the data right now, it's not looking that great. I mean, the rupee is at a record low, trade deficit is very high. There is pressure on the fisc.
Yes.
And globally, global debt levels are alarmingly high, right? Across, whether you look at the US, Japan, etc. Do you think all of that will come to boil at some point in 2026?
Actually, which is what you're seeing. In India, we are getting impacted more due to the global uncertainties than the local uncertainty, right? So, like you said, the recent, the yen unwinding which is happening, the carry trade which is coming to an end, which is creating a selling pressure. FIIs continuously have withdrawn almost $15 billion from January till date. So that's taken a huge toll on our markets. Now, why FIIs have withdrawn? Not because they don't like India. They have withdrawn because the US Treasury yields are looking very, very high. On the other side, Chinese markets were looking very attractive in terms of valuation. So a lot of foreign capital has moved into China. So the Chinese market also has got re-rated from a 9 PE multiple to today about a 14 PE multiple. At the macro level, you're right that even if you see US, while it's done well, US markets have done well, but the rally has been very polarized towards the AI companies and the tech companies. I mean, if you just remove them, the markets will just fall flat. Now, there is a concern on valuations even in that space in US. Apart from that, US economy, of course, is slowing down. US debt to GDP is pretty high, right? It's almost 140, 150%. Now, macros is very difficult to predict, and how US navigates through, how do they bring the growth back, and tariffs also is impacting the growth, right? So if you see the last few numbers, their economy has slowed down from 2.1% to 1.9%, and inflation is inching up, which means that what will Fed do now? Will they cut rates? Will they hold on? Or will they increase? Nobody knows, right? So, in these kind of situations, yes, it's kind of difficult what one needs to do and which country you want to play, honestly. Amongst all of this, I'm making a point that our macros compared to the US macros or Chinese macros or Japanese or Europe, these are the large four large countries or continents you can play. We are looking far more better. The only concern in our market.
What makes you say that?
Like I said, we clocked 8.2% GDP. Great news. We are seeing recovery in the earnings growth. Great news. We are seeing lower inflation. Great news. We are seeing possibility of rate cuts, positive for equities. Great news. The only thing is the dollar, the rupee depreciating. Now, why is that happening? Like you rightly said, because of the tariffs, the exports are slowing down, right? So that is where we are seeing the trade deficit. So import is happening, and then we've had the Diwali season, and then all the marriage seasons coming up. So the import is largely because of commodities, largely because of gold, right? So that is where the trade deficit is kind of coming up. So and then RBI is actually not intervening much to protect the rupee depreciation because they have to take care of their reserves. So there are a lot of things which are playing out apart from this currency depreciation part. I think broadly all parts are looking pretty healthy in India. And that's kind of translating into earnings. And if the earnings sustain for the next 3 or 4 quarters, then markets will try to discount the future. Then they will look at what will happen in 2027. 2028 numbers will start to come after December for the earnings forecast. And then markets, will discount the future. So I think just a little bit concern on the valuations. If we can have maybe 1 or 2 quarters of maybe flat markets, and earnings are accumulating, so the multiples will start to look better. If over the 12 months you look at small cap premium over Nifty 50 has already come down. The premium is just about 17%. Mid cap continues to be at 50% premium still, but it's backed by growth, right? So I think in this kind of a market, it's not too much about index now. In this kind of a market, it's going to be about fund manager skills or stock picking skills. Stocks will make money. Or stocks will protect your money from depreciating, and that is how you will make returns. So I think we say that it is probably time for alpha. So markets will go somewhere, and good fund managers, good stock pickers will largely outperform the market.